Imagine you are right about the market. You call the direction, you pick the right stock, the right macro theme, the right timing, and you still blow up. That is not a rare story. It is the most common failure mode I see. The killer is not being wrong. It is being too big when you are wrong. Position sizing is the quiet part of consistent profits, not the exciting part, not the part people brag about, but it is the part that decides whether your edge survives long enough to matter. Edge means a positive expected value, which is just a fancy way of saying that over many bets, your average outcome should be positive. You can have edge and still go broke if your sizing is reckless, because variance is real. Variance means outcomes bounce around your average, sometimes violently, sometimes for longer than your patience. I want you to think about the difference between being correct and being solvent. Solvent means you can keep playing. In markets, staying solvent is the first job. This is why so many great investors talk about avoiding ruin. Risk of ruin means the chance your account gets hit so hard that recovery becomes mathematically or psychologically impossible. If you lose 50%, you need 100% to get back to even. If you lose 80%, you need 400%. That is convexity in reverse. Convexity means the relationship between gains and losses is not linear. Losses hurt more than equal-sized gains help. The cleanest way to understand position sizing is to stop thinking in dollars and start thinking in percentages and probabilities. A $1,000 loss is nothing to some people and life-changing to others. A 2% loss is 2% for everyone. When I size a position, I am deciding how much of my future I am willing to risk on one uncertain idea. Look at LTCM in 1998. Long-term capital management had brilliant people and sophisticated models. Their trades often looked like small edges with high confidence. The problem was leverage, which means borrowed money or embedded exposure that multiplies outcomes. With enough leverage, a small move against you becomes a catastrophic move. Their models leaned on historical relationships, like the spread between similar bonds narrowing over time. Correlation is the measure of how assets move together, and in calm markets, correlations can look stable. In a crisis, correlations can jump toward 1, meaning everything moves together. That regime shift, a change in the market environment, turned their careful-looking bets into one giant bet. Their position sizing assumed the world would behave like the recent past. When that assumption broke, the sizing broke with it. Or take Barings and Nick Leeson. The story is often told as one rogue trader. It is also a story about controls and incentives and unchecked size. When losses are hidden, positions grow to try to earn it back. That is loss chasing, a behavioral trap where you increase risk after pain. It feels like taking control. It is usually the opposite. The account becomes a hostage to one outcome. The firm becomes a hostage to one person. Position sizing is not just a personal skill. It is a governance issue. Now bring it back to you. Consistent profits do not come from never being wrong. They come from having losses that stay small enough that your winners can matter. That sounds obvious, but it is hard in real time because your brain hates small losses. Your brain wants to avoid being wrong. It wants to average down without a plan. It wants to double size after a win because you feel invincible. That is recency bias, which means your mind overweights what just happened. It is also overconfidence, which means you underestimate uncertainty because you feel certain. So how do I think about sizing in a practical way? I anchor on drawdown. Drawdown is the peak to trough decline in your account. Drawdown is not just pain, it is a risk constraint. If your strategy has a history of 10% drawdowns in normal conditions, you should expect worse at the wrong time. If you size so that a normal drawdown becomes a 30 or 40% drawdown, you will change your behavior. You will cut winners early. You will hold losers longer. You will stop following your rules. That is why sizing is psychological risk management, not just math. Volatility is another key input. Volatility means how much an asset tends to move around day to day. A position in a sleepy utility stock is not the same as a position in a high beta tech name or a leveraged ETF. If you size both with the same dollar amount, you are lying to yourself about risk. A simple discipline is to size smaller when volatility is higher. This is why many pros think in risk units, not share counts. They ask, if this moves against me by a normal bad move, what % of my account do I lose? Normal bad move can be estimated with average true range for traders or with historical volatility for investors. None of these are perfect. They are still better than guessing. I also respect liquidity risk. Liquidity means the ability to exit without moving the price too much. In calm markets, liquidity looks abundant. In stress, it disappears. Small caps, options, and crowded trades can gap. A gap is when price jumps past your stop. This is where people learn that stops are not guarantees. Stops are instructions, not insurance. So if I am trading something that can gap, I size as if my worst case loss is bigger than my stop. That is tail risk, which means low probability outcomes that do most of the damage. Let me connect this to some well-known styles. Warren Buffett is often seen as a buy and hold investor, but his position sizing is not naive. Berkshire tends to concentrate in a few high conviction positions, but the structure includes massive liquidity in the form of cash and operating businesses, plus the ability to hold through volatility. That is a different game than a leveraged trader. Buffett can survive drawdowns because his liabilities are stable and his time horizon is long. Time horizon is part of sizing. If you need the money next year, your true risk capacity is lower, even if your account size is high. On the trading side, Paul Tudor Jones is known for caring deeply about defense. He has talked publicly about always thinking about what he can lose. I cannot verify private rules, but the principle is clear in his career. If you want to stay in the game across decades, you cannot let one idea define you. George Soros is famous for big trades, but the part people miss is that he cut risk when he felt the thesis was wrong. Reflexivity, a concept Soros popularized, means prices can change fundamentals and fundamentals can change prices. In reflexive markets, your thesis can break quickly because the market itself alters reality. That makes position sizing more important, not less, because the feedback loop can accelerate against you. Stanley Druckenmiller has spoken about pressing when the odds are strongly in his favor. But pressing is not the same as gambling. Pressing requires a clear risk limit and the willingness to reduce when conditions change. The difference between a professional press and an amateur press is that the professional already knows where they are wrong. Now I want to address a dangerous misunderstanding. People hear about the Kelly criterion and think it is a magic sizing formula. Kelly is a way to maximize long-run growth when you know your edge and your odds. In plain English, it tells you how big to bet when you actually know the true probabilities. The problem is that in markets, you do not know them. Your edge estimate is noisy. If you bet full Kelly on a mismeasured edge, you can blow yourself up. Many serious operators use fractional Kelly, meaning they bet smaller than the formula suggests because they respect estimation error. Estimation error means your inputs are wrong, even if your math is right. So what position sizing strategies actually help consistent profits? The first is accepting that consistency comes from controlling the left tail. Left tail means the bad outcomes. If you cap losses per idea, you reduce the chance of a career-ending event. That usually means risking a small % of capital per trade or per theme. Small does not mean timid. Small means survivable. You can still compound strongly if you avoid deep drawdowns. The second is separating conviction from exposure. Conviction is a feeling plus an analysis. Exposure is math. You can feel high conviction and still size modestly because you know you could be wrong. In fact, the highest conviction trades are often the most crowded. Crowding means many players share the same position. Crowding increases crash risk because everyone tries to exit together. That is when correlations spike and liquidity vanishes. A smart position size respects the crowd. The third is adjusting size to correlation inside your portfolio. Diversification is not owning many things. Diversification is owning things that do not all lose money at the same time. If you own 5 tech stocks, you do not have 5 bets, you have 1 bet and 5 wrappers. In 2000, many investors learned this the hard way. They thought they were diversified because they owned many .com names. The factor exposure was the same. Factor means a shared driver like growth, rates, or oil. When the factor turns, everything turns. The fourth is respecting leverage. Leverage is not evil, but it is unforgiving. It compresses time. It forces liquidation. It turns a drawdown into a margin call. A margin call is when your broker demands more collateral or closes you out. Many traders do not go broke because they are wrong. They go broke because they are forced to exit at the worst possible moment. If you use leverage, your position sizing has to assume you will be wrong at the same time volatility rises. That is exactly when your risk gets multiplied. The fifth is being honest about your behavior under stress. This is the part most people skip. If a 10% drawdown makes you abandon your process, then your real risk limit is below 10%. Your plan must fit the person you actually are at 2 in the morning when futures are down and your phone is lighting up. Consistency is not just returns, it is repeatability. Let me give you a simple mental test I use. If this position goes against me quickly, will I be able to execute my exit without negotiating with myself?